Good morning, lads. How are we?
Bloody awesome. I think better than you. You sound pretty crook.
I feel like I've been hit by a 128 this morning driving the porcelain bus. So there has to be something in the learn to swim pool. It was like 3 times now, Maggie and then me and then the other kids. But when I signed up for the half Ironman, I didn't really think through the reality of 3 young kids means you're sick every week. And when was I going to fit the training in?
There is that. But I remember during the marathon training, you used the to your advantage because it forced you to run to find public toilets.
Yeah, no, that's true. What have you been up to, Jack? You've got all this ahead of you.
Yeah. I haven't been up too much, just rugby on the weekend, training, and then just been pretty flat out at the moment at work.
During one of the interviews this week, you had to clarify what you actually meant by rugby.
Yeah, so I'll say footy. I suppose I spent the last 10 years in Queensland, so footy to me is rugby. But yeah, down here,
union.
footy's... Yeah, union. But if you're from Mackay, which when we're having a chat to a person, they were from Mackay, footy would be rugby league, I assume, up there. But footy to me is rugby union. But down in SA, it's definitely AFL.
And Aaron?
Yeah, it's been busy. Went to Ford Fest last week. I was up there for a day. That was good. Mostly sat on Zoom calls for most of the day, but it was good to catch up with people. And then last night there was a dinner with some founders, which was good. And it's my daughter's birthday today. She turns 11.
Happy birthday.
Yeah, so little Mia is growing up way too fast.
Yeah. What did Matilda say to me the other night? Dad, why do you have to say so many silly things? She's 4. Like where does this attitude come from?
My son sent me a reel that someone had created about the trauma kids experience from dad jokes. It's like, Dad, if you could just please fewer dad jokes.
Yeah. It's been a big week for us, starting some initial interviews for the investor relations role. And that's been exciting.
Yeah, and we're still getting more applications come in, and I'm blown away by the caliber of people who want to work with us and who wants to work and join the team. It's bloody awesome.
Clearly, when they only engage in LinkedIn posts, they don't realize the people behind the post. So that's good.
Yeah, it's funny with some of them I've been saying, hey, just listen to our podcast, get to know us a little bit, then see if you still want to work with us.
That's been really good. And I guess with this particular role, we're after the outcomes, and therefore it comes with a lot of flexibility, a lot of opportunity to be creative. And, we're trying to build a great little company from the ground up. So someone that enjoys that stage. Yeah,
and it's been good chatting to a few people in the interview process who are probably more a fit for us down the road at a later stage. But yeah, really excited about all the different potential people who could join us at different points.
So just a bit of a recap. I had my rant and diatribe on offsites last week.
Oh, that was a great article, Don. That was bloody good.
Yeah, that turned into an article that Eloise Keating put together for Smart Company. And it got some really great feedback. Even Libby's family just saying, how is it that you took live snakes into an offsite? I'm like, do you even have to answer that question?
Yeah, I don't know you.
But during the week, one of the founders I was having a chat to who he had facilitated an offsite, I thought it was just worth sharing this. If you adopt the PIP process, so potential improvement points, all your strategy, all your goals, all your OKRs, all of that exciting stuff, but then accumulate what potential improvement points would we have to resolve in order to achieve all of those things? And they tend to be small issues. And what tends to happen is because founders are so energetic, they're building something to change the world. There's so many big things they've got to sort. They can become very dismissive of the little things. And so in every one of these processes, there's some small issue or a series of small issues that the founder goes, are you serious? Are we really worrying about that? We've got all of this stuff to do. And then what happens is they dismiss it. And then because it seems more exciting to start with the big items, that's where they put all their energy. But you've got to think about the post-offsite environment a bit like turning up to the gym. If you turned up to the gym and try and lift 500 kilo weights at day one, you're either going to give up or you're going to hurt yourself. Where actually you should start with 20 kilos, then move to 40 kilos, then move to 60 kilos and build up. But too many methodologies and too many HR consultants and too many strategy gurus sort of almost support companies going after the big cultural things, the big strategic things. But actually you've got to think about it like organizational muscle, organizational energy, and actually taking small things, getting them resolved sends big, strong signals to the staff. Right. So you asked me to have my say. I raised a few things, and then very quickly those things went and got fixed. Wow, there is some change here. And then with those little things out of the way, not aggravating people, then we can start to move to big bits. So I just wanted to share that, because the energy of CEOs and founders and boards is often, don't worry about that little thing. We've got bigger fish to fry. It's like, well, no, you want to create a culture where ordinary people can come and achieve extraordinary results, rather than constantly trying to find extraordinary people. And the reality is the majority of people do have some challenges with small things. If you don't provide them with the right facilities, if you don't provide them with the right training, if you don't provide them with the right documentation, all of those things give people the shits, and then they pull up stumps and they leave.
No, it's a good reminder. And as you were saying that, Don, I remembered a founder that I had a quick catch up with this week, who had a later stage, like an advisor from a later stage company experience. And that advisor had told them from day one to set up as a public unlisted company. They put a board of 5 in place, and this was a pre-revenue company. And this is a recipe for disaster at your stage. Like you're high process, you've lost autonomy. Like you are not going to be able to do the things you need to do at the speed and pace you need to do them. And this is the challenge for founders. Like it's one thing to be aware of who you're taking advice from, but thinking about the stage of experience that their advice is coming from compared to the stage that you're at, and making sure that advice is stage appropriate.
Yeah, there's need sometimes consulting and advisory when we're missing domain expertise. But the amount of consulting and advisory that's destroyed companies is incredible, because they don't first have a life cycle model, and what works at one phase kills at another. And so then you've got a consultant, and look, having been one, it's not easy, but the reality is it's easier to tell someone what to do than go and do it yourself. They just don't take into account life cycle, location.
Yeah, the other little quick catch up from last week, we wrapped up quickly at the end of the episode because we were dashing off to a shareholder meeting. And it was random when I was at not Ford Fest, some other event. Someone said, "Oh, how did your shareholder meeting go?" Which is really weird when some random you don't know just suddenly asks you a question about your life. And it's like, oh, that's another.
Oh, that's right. I'm hanging up all my dirty laundry.
Yeah, exactly. But I got to say, like when you have a shareholder like that, I just walk out of those meetings. We've said this before, like you feel 7 foot tall and bulletproof. And I think this is the value when you've got good shareholders, having regular catch ups and sharing your challenges, sharing what you're working on. And when you involve them in that process, geez, it's empowering when they're the right people.
Yeah, that was a really good conversation, that once you reflect on those points, as long as you can take energy from it, then you go, yeah, you know what? That is right. Good. All right. On the bike, let's go and do it.
And even for me, it was also that reminder, even your founding shareholders that have been with you on the journey from day one, you still have to remind them who you are and what you do. It's like, yeah, when you start getting, isn't this different to what you've been doing? It's like, no, that's exactly what we've been doing.
No, it's important to people to realize that you live and breathe your own business, and the people that are invested or advising or on the periphery, they've got their own stuff. They're not thinking about you 24/7, and they're busy. And then sometimes it's just hard to keep up to date with everything. And so that connection is really important.
Yeah.
Well, let's get into some news. So a great Queensland company that's been supporting founders and companies with a large investor syndicate is TEN13, and they passed $100 million deployed.
Bloody awesome. Like huge achievement. They've been going since December 2019. Yeah. So what's that, 4.5 years? Their first deal they shared had 30 investors. And then fast forward to today, they've invested through 80 rounds of funding into 50 companies across 6 continents and 100 million deployed. Like that is a huge achievement well, I was going to say to Steve, but particularly to Stu Glenn, who's been leading that, and all the team there.
Yeah, I don't think anybody would argue that Steve has lent a lot of brand and networks and whatever else, but Stewie and the team are the little engine that could.
Yeah, just remarkable. It was interesting. Someone saw that and asked me, yeah, do we benchmark off that and how do we measure ourselves against? I'm like, no, our strategy is different. And then, yeah, for some founders, I think that there's this connection. If you're a syndicate, you all operate in this way and you're all aiming for volume and you're all doing this. It's like, no, actually our strategy is high touch.
And then because ultimately we're syndicating for the purpose of building a fund, the idea of syndication for a number of years is to build a track record, get a brand out there, really hone the thesis, work with founders, but we're not we will syndicate in parallel to the fund, but the syndication for us is a means to an end.
Yeah, and speaking of raising funds, the news that OneVentures have raised their 7th fund, 200 million.
How good. It's been a little while.
I've forgotten that we had the sound effects. They've been missing.
Yeah, seventh fund. What I find really interesting, and we'll get to some of the later articles we're going to talk about. 7th fund, first time engaging with a super fund.
Yeah, which was interesting because I actually spoke to Anne-Marie Burkle is a good friend, and I often go to her for different advice for us, and she was talking about deliberately avoiding institutional funds was part of their strategy because of the overhead and other things that they needed. So this is an interesting shift for them, having been heavily reliant on mostly family offices to date.
Yeah, in the article that was posted by Capital Brief, Bronwyn Colloon, the journalist, it says that one of the founding partners, Michelle Deeker, told Capital Brief there's a significant opportunity in the Australian market right now for growth capital investing. She highlighted the gap between where venture capital may play and where the big global funds come in, especially for companies around 5 to 15 million. So this smells quite a bit like what EVP has just launched, which is effectively targeting that. Would it be fair to say we're now in, is this just Series B, Series C, Series D? Is that the way to look at this stuff?
I think so, yeah.
And Michelle said that we've been returning capital and we've got more capital being returned. In the next 8 months, we're probably returning another $100 million to investors. And that's what this game's all about, right? And they've put in the time, they've made the good investments, and they've started returning the dollars.
Yeah, and we see this time and time again, like the funds that return capital to investors, create that liquidity, go on to very successfully raise more funds.
Now, I don't want to jinx it. And as Donald Trump would say, touch wood wherever we may find wood. Hang on, have I still got you or have I lost you?
Well, was it the silence when we didn't laugh?
I'm very run down, quite emotional, Adrian. I can't even get your name right. Aaron, I need some support, please. We may have our first exit.
Yes.
Term sheets are being signed, and great outcome for the founders who have been really working hard.
Really great outcome, a great outcome for the founder and for us as a very early emerging fund manager. It's a really positive outcome.
Yeah. Now, awesome work to the OneVentures team. And I must admit it's been on my list to get Nick from their venture credit team on. I'm embarrassing our brand with the backup of people that we're going to have on the potty, but it has reminded me to do that. Now, an article in the AFR by Paul Smith is titled Australian Venture Capital Firms Face a Battle for Their Future. He says, Australian venture capital firms face a battle for their future as the superannuation sector weighs up less risky options. Many in the market are looking to super funds to bankroll the next generation of ventures, but hope is fading as the biggest VC backer, Host Plus, reveals it will reduce rather than expand the number of firms it backs. OneVentures, the well-credentialed firm, joins a myriad of VCs, including large peers such as SquarePeg and a scrum of smaller operators, jostling for over $1 billion from super funds, banks, high net worth individuals, and family offices. We know that there's a lot of smaller funds that are really struggling out there for various reasons, and syndication is hard at the moment, obviously, with everything that's occurring, but I'm glad we're not spinning our wheels trying to close a captive fund, because you just wouldn't be able to deploy anything. You wouldn't be able to develop brand. You wouldn't be able to deliver to founders.
Yeah, this article, I mean, we've been talking about this for a while, this challenge in the market, but it is interesting on Host Plus. I mean, we engaged Host Plus early, and it'd be fair to say, I saw your comment there, Don, like naively. That's very true. And as generous as Con and the team were with their time and everything else, like the reality is the first time fund manager going to a super fund and asking for cash isn't exactly the model for success.
Is Con the funniest bloke in the investment landscape?
Oh my God, he is hilarious. Like, yeah, so good.
Fellow South Australian, Jack.
Yeah, he's good.
Yeah, we were a bit naive, early stage startup. We didn't quite know, but now we've got a bit of a picture of what we need to look like. So we're just setting a path of development. It's a bit like, it's the life cycle, right? When we've grown up a little bit and we have arranged all the systems and processes and controls and all the things that we need to have, that's when we'll go back and look at that sector. But I did, just to remind, it's just interesting that they're moving away from backing some emerging fund managers, because on this podcast, we've discussed many times, there are so many data sets that just show the IRR, the internal rate of return, drops as a fund gets larger. Now, for these big super funds, they're really trying to play the low fee game because they get compared so heavily, and they're trying to get absolute dollars returned. If you're a big super fund with $1 billion to put into venture, you don't want to be screwing around with small checks. You actually need to get those dollar returns. But it significantly drops off as the fund gets bigger, where that IRR is. So I think the industry would be well placed for some programs to be able to support emerging managers. Now that I say that, I get a bit of a trauma response from one program, but we'll leave that well alone.
Yeah, let's not go there.
Yeah.
But yeah.
And there was another chart related to this that I found from PitchBook and chronograph.pe, the percentage of emerging managers able to raise fund too. Pre-COVID, it's like 60 to 70% of fund managers every year, going back to 2006.
Yeah, consistent. That's like, what, 14 years of...
Yeah,
15?
yeah. And then COVID comes along, post-COVID hangover, 12%.
That's just plummeted. Bang.
Well, that's all right. We'll keep at it.
But that's like the aftermath of FOMO, right?
Yeah.
Yeah.
It just brought forward so much investment. That's the problem. If you believe in mean reversion, like we just had 2 and a bit years where it actually brought forward 4 or 5 years of investment dollars, and all we've got to do is be the cockroaches to still be there on the other side of that.
This game's all about a scoreboard. So if you've got a shit scoreboard, it's hard to go back out to your LPs and ask for more money. So regardless of the climate, like if you've demonstrated that you can get outlier returns, you're always going to be given follow-on capital. But if you haven't, and you've invested at ridiculous valuations, and now you've got a portfolio of just very average companies that you paid a really high price, like how do you justify it?
Yeah, spot on. I do have a little cynical thought around this chart, also demonstrating the Ponzi scheme nature of funds. Like if a fund is raising capital and deploying it, and also leading future rounds and pushing up values, like there is this almost self-fulfilling prophecy, right? Like the paper value of companies that are really being valued by the same entity if it's staying as the lead investor.
You mean like an investor that's the same investor across 2 companies and then facilitates a hospital pass transaction at a really high multiple, and that may inflate the underlying returns, like that kind of thing?
Kind of thing. Yeah, like maybe some things we're seeing at the moment where there's inter-portfolio transactions occurring and questions over who's setting those values and how those acquisitions are being priced.
Don't hate the players, Aaron.
No, that's true. They're playing the game. Absolutely.
Yeah, and to be honest, if that is the case, you still got to pay the price at some point because you're passing on to another fund.
Well, 100%.
Like, so I actually, yeah. So I don't think, like, I think as an LP you'd look through that, and surely a GP would look through that as well.
100%. The only caveat I put on that is because it's a game of such a long-term horizon that I think cycles can mask what would otherwise be failures. And so,
yeah, but the goal is to get it into the next innings, and if you can ride out a bad cycle, and as long as it works out on the other side, often, however, it doesn't. But yeah,
totally. It's the nature of the game. I get that, and you're right, Jack. Like these things are inevitably paid at some point.
Now, not only like emerging funds battling, I don't know about you, but the last couple of weeks, AI has just turned. It's like turned into a bit of a battleground where suddenly there's more and more podcasts, more and more articles, more and more people coming out going, hang on, the world's spending $600, $700, $800 billion on this. Is this actually justified? And with some of the smaller companies that got traction, in the face of some of these big gorillas that can literally spend billions upon billions of dollars, how the hell do you compete? And there was an article by Nick Bonyhady talking about Leonardo's sale to Canva. He says AI startup Leonardo earned $1.25 million in the month before it accepted Canva's buyout offer, but was finding it more challenging to grow users and faced hundreds of millions of dollars in capital costs to build new imaging software. The company's lead investor, Blackbird, revealed Canva had bought Leonardo for US $250 in a confidential note issued. Blackbird, whose reputation was forged off its early backing of Canva, stands to be the biggest winner of this transaction. It collects a return of nearly 4 times its investment and extracts a rare exit from the venture capital drought, but also loses a prize candidate in Leonardo to replicate Canva's success. But there's no parallel world, but I smell a company that was getting good growth, but staring at the need for hundreds of millions of dollars of investment that shareholders were just not going to be able to support. I would love to have seen what had happened if they just waited 6 months.
Oh, totally. But look at the valuation multiple, 1.25 mil a month. Now, we don't know the growth rate. We don't know rule of 40.
Oh, we do. I added a chart. If you have a look. So this takes some of Australia's best startups, Leonardo, Canva, Blink, Tracksuit, Safety Culture, and Culture Amp, and plots them from month one. So in actual fact, if you look at Leonardo, the sprint to AR clips outstrips Canva.
Yeah.
Actually, for the YouTube watchers, I'll share my screen here. I thought this was really fascinating. These guys outstrip Safety Culture, Canva, like by a big order of magnitude.
That's massive. Like they came out of the gate. Wow, look at that. 13 months of just solid growth.
Safety Culture was at, I don't know, 2 million. Canva had at the same point, Canva was what, 1 and a bit billion. So look, there's an amazing growth rate there that, let's say that it was able to continue. Like I'd say 250 million will turn out to be cheap if it can continue. But what Nick is saying in this article, and was actually said in the Blackbird note, it said the Blackbird pair wrote that Leonardo had reached 15 million in ARR revenue before it was sold. However, the months prior had shown that new users were harder and harder to come by as early adopters neared saturation. I just find it interesting that they're saying hard to continue to invest hundreds of millions of dollars and user acquisition had slowed. But this is smart. Punt it into a much bigger behemoth that has a much bigger opportunity to invest. Like Canva could, I don't know, raise $1 billion on the back of a cigarette packet to fund more stuff in AI. So they're a better owner for this. Jack?
Yeah, go.
Yeah, I don't really have too much to add here, but I don't really know what to think because, yeah, they got 4X, but it's 4X on a $300 million vow, not a $20 billion vow. So there must have been enough indicators to say, let's handball this off now.
Yeah, we want to get off this ship.
It is still a win-win because Canva still has a lot of headwind, like growth to grow. Like even though they're at a $20 billion vow, like this space is changing so fast. And what Leonardo's mission was, like they could totally capture a whole nother market. So it's going to be very interesting regardless. And it's a great outcome for Blackbird.
Totally.
Yeah.
And I think the segue that I've put in here to another article that I'd found from Benedict Evans, and Benedict previously worked with Andreessen Horowitz. The problem is that there's been a big growth in first-time users of a lot of AI tools, but not many are actually coming back. And they haven't found a sticky way for a lot of these corporates to actually implement it. And so at the beginning of this article, which I'll put in the show notes, I think that's really great, partly because it's got so many charts that are actual charts that I'm going to steal. Hundreds of millions of people have tried ChatGPT, but most of them haven't come back. Every big company has done a pilot, but far fewer are in deployment. Some of this is just a matter of time, but LL might also be a trap. They look like products and they look magic, but they aren't. Maybe we have to go through the slow, boring hunt for product market fit after all. And so I'll share this screen just to flick through a few. Benedict said, my old boss, Mark Andreessen, liked to say that every failed idea from the dot-com bubble would work now. It just took time. It took years to build out broadband. Consumers had to buy PCs. Retailers and big companies needed to build e-commerce infrastructure. A whole online ad business had to evolve and grow. And more fundamentally, consumers and businesses had to change their behavior. The future can take a while. It took more than 20 years for 20% of the US retail to move online. And they've got a chart here showing that. I mean, that it's just a really good reminder that stuff always takes much longer. And you can see where there was this big jump in COVID, but then we've gone back to the mean trend. But yeah, 20 years for 20%.
The chart's not sharing on my screen. I've got a media board view from the sound effect. It's not actually, I don't know if you can see it. You can see it? Oh, okay. Well, it's just mine. All right, ignore that.
Earlier on, before we started, Jack, Aaron was complaining that my editing was poor because Aaron sounded really terrible. And I had to explain to him, don't blame the tools, mate.
But there is legit one episode I was listening to myself and it sounds like I have a speech impediment. And Don was like, no, that's how you sound normally.
Yeah. So Aaron's come to offend all the minority. So thank you, Aaron.
I'm off to the therapist this afternoon. But on this topic, oh, sorry, Don, you go.
Well, I was just going to say, people forget that the iPhone took time as well. Apple sold only 5 million units in the first 12 months, and it took until 2010 for sales to really work. Like ChatGPT happened a lot faster, and it exploded into our consciousness in late 22, and it's taken all of the oxygen almost immediately. But if you're building a startup that isn't focused on generative AI, all your friends will point at you and laugh. But much more importantly, ChatGPT got to 100 million users in just 2 months. Yeah.
For me, this is the tech adoption diffusion curve, crossing the chasm, going from the early adopters who love the tech, they're happy to experiment, they'll give it a crack because they're excited by the technology. But at some point, if there isn't a real value add, you won't capture the early majority that's across the chasm. And I think that's what we're seeing. We're seeing people adopting early for the love of the tech and the experimentation and the education from that, and to the influence of saying, I'm on this tool, I'm on this tool, but we haven't seen the real value delivery to cause that crossing of the chasm to work for some of these companies.
But I'm so surprised by that. Like, I use ChatGPT every single day. Like, for $20 a month USD, my productivity goes through the roof. Like yesterday, Aaron, I was doing a task, first time doing it, didn't know how. You were away doing something, bang, straight into ChatGPT. I solved the problem in 5 minutes, not talking to anyone. And then, like, that's just myself as an investment analyst. You look at it as someone who's a dev, co-pilot for writing code, someone who just needs to write a long email and just to get it to quickly read through it. It saves so much time. I don't know how we can't say like the tech isn't being adopted because it's so useful.
Oh, and look, it's really reassuring to hear that when I'm absent for 5 minutes, I'm replaced by ChatGPT. But yeah, spot on. Like, I think part of it is the understanding of how to get value from it. I think for some, they struggle with the adoption to extract the value, even though it can be valuable.
But Jack,
yeah, no, I agree with that.
But humans
I can see, like, just to go back to this article, I can see like there's a lag for an enterprise to sign a company-wide contract, but on an individual level, like I pay for ChatGPT myself, like it's $20 a month. You know what I mean? Like so I still think while we might not see these large enterprise contracts signed, there'll be a lag for that to come through. Like everyone's using ChatGPT that I know. Like it's so useful.
Jack, can we please pay for that for you?
Yeah, I am embarrassed. I'm going to have to edit this out. The analyst is springing for the $20 a month because we won't pay for it. Like,
Jack, just put it on the Tribe card, mate.
Yeah, well, it wasn't even that. It was just, when it first came out, paid for it to trial it. And then I was like, this is so good. I haven't canceled my subscription. That's all.
Yeah. Oh, look, I use it for all sorts of things. It is a bloody handy tool with.
But I think what we're really talking about here, it's fine for a whole lot of individual punters to get some value, but these companies, and we're about to talk about one that Blackbird has written down to zero. These companies scaled up and hired massive teams with the view of getting an onslaught of revenue from corporates.
Yeah,
this is part of the challenge. They've gone and invested all of this capital. They've gone and done all of this growth. And that the revenue was just going to magically come out of nowhere. And this is the problem. It hasn't. Now, are there some people with really well-known brand stuff like a ChatGPT? Totally. But if you look at this chart here, capital has become the moat. And so what's happened is that these AI-first, AI-led companies, if they couldn't get shareholders to keep throwing in dollars to fine-tune the model to beat the next competitor, they've just died off.
And this is really interesting. Like that episode we recorded with Tom from Blackbird on Friday.
So good.
And his article about AI enabling vertical SaaS to almost have a product-led growth strategy. Like for me, yeah, this kind of shift of these AI products that are coming into companies and they're doing it on the basis of a belief that they'll get land and expand. So they'll get like the old Salesforce model. Someone puts it on their credit card and then it goes broad. I think what we're seeing is that's not working yet, or we're not seeing the data that it is working for enterprise sales.
But if we use ChatGPT as the example, it's the analyst has gone and paid for it because it gives that much productivity at an individual level. Like his example was the doctor for Heidi Health. Now you guys hear about this. All right, now we go an enterprise 3-person license. Like that's the exact playbook. And prior to that, when we were going horizontal, it had to be an enterprise wide. So it was so much harder to get that sale over the line. Saying we're going in as an individual level now and there's this whole vertical play open. which was previously only a horizontal play like safety culture.
I think you're right, Jack, and I really agreed with what Tom said, and I look forward to getting that episode out. I think the problem here isn't the product or the market or the whatever else. It's the assumptions, probably driven by the venture capital model. I'll go and give you $60 million, and out of nowhere, I'll get you to build a rapidly scaling business because Canva did it or something. Like an example of 1 out of 10,000.
You sneezing, Dom?
Mate, I'd be happy if it was just a sneeze. No,
It would be an absolute disaster.
Anyway, back to I think it's part of the venture capital model that's like, oh, we'll put all this capital into this big thing so we can get scale. But most of the time, you can't outgrow the life cycle. You have to get born. You have to progress into the toddler phase. You have to move into the adolescence phase. And what happens is companies try and, I think, go a little bit too hard. Now, I can't say that's exactly what's happened here, but there's some interesting things in this article. So Nick Bonihatty again from the AFR. Blackbird, Tiger Global-backed startup, shares value at 0. Retail AI startup called Hivery, backed by Blackbird Ventures and Tiger Global, has suffered a series of blows as its biggest local investor wrote the stake down to 0 and 2 co-founders departed. Hivery, which raised more than $61 million from funds that also include OneVentures, AS1 Growth Partners, makes software to help retailers choose which products to stock. A number of the co-founders have departed in a wave of cost cuts. Venture capitalists have previously warned that there are zombie companies still operating in a sector that raised money in bull markets but have since faltered. Like, I think this is a carry on for that. I'm sure Hivery had a whole lot of growth to justify throwing in 61 million early, but they haven't been able to maintain it. Sounds like they've had a massive cost structure. Blackbird and AS1 haven't given up yet because it says in the article in April they gave them another 3.8 million to keep the lights on, but a number of the founders have departed. And what's interesting is a couple of the comments says, my personal motivations have started to diverge with where we were heading, Mr. Vanden Brill wrote, who's one of the co-founders. So we often talk about integration, disintegration, alignment, and it sounds when things started to get challenging, there were different views, and that different view has led to conflict, and that conflict has led to people going, no, I'm out.
Yeah, and one of the other co-founders had launched a new company. So yeah, definitely disintegration going on there.
But I have a feeling that a bit like the 2000 tech wreck, where a lot of companies just disappeared because they couldn't get the early growth, they couldn't get the capital. As Benedict said in that early article, all of those things could have survived today once the infrastructure was there, once the clients were ready, once all of the use cases. And I think we're just in the normal creative destruction start where the first movers, the majority of them get killed. They create the path for others to then walk over their corpses.
Yeah, or even if they're not corpses. Like when Uber launched, they spent billions doing a brute force attack on legislation and educating the market and getting people comfortable with ride sharing. And then DD launches at a fraction of the costs, like can quickly activate onto platform all these existing drivers that are already on Uber. Even if there isn't, even if the zombies don't turn into corpses, or even if they're not zombies, they're doing well. First movers create a pathway for others to follow at a cheaper cost.
Jack?
Yeah, I agree. It's just so hard to know. Like, it's moving so fast. Like AI, for example, collectively we agree that this technology is going to be around, but we just don't know which vehicle is going to be the one to win. And we know there's multi-layers within the whole AI space. But going back to the early 2000s or the personal laptop, like Osborne was the first laptop to come through. They went bankrupt, and then second, third, fourth competitors came through to really win in the space. Like, it's just so hard to know. The market doesn't even know who's going to win. Like, it's such a hard space.
Which is why being a early fund manager and syndicator, we've taken the conservative approach of staying away.
Yep.
I thought I would just play that little Harry Stebbings clip that I shared with you yesterday.
Oh, yeah.
I just think it's quite...
I think it's quite relevant.
Interesting. I don't want to scare too many people off, but let me just go screen and also share audio.
A lot of the stuff Mark Andreessen says on this, where he says, like, people don't have religion in Silicon Valley, so they, like, worry about AGI. And I think that it's this unknown that people want to talk about.
I had Ethan Mollick, who's a professor of AI societal implications, on yesterday, actually, and it was fascinating. He said that no VCs actually make sense today who believe in AGI and are still investing in SaaS.
I
So
love
it's
that.
complete
Yeah.
bullshit. Because if you believe in AGI, your tax accounting product for SMBs will not fucking exist if AGI is there. And so you can believe in AGI, but then only invest in AGI, or you can not believe in it and keep investing in SaaS. But to hold two is not mutually compatible.
I love that. Humans love consistency, right? So yes, that's inconsistent.
Yeah. The problem is I don't know whether I do fully believe in a fully AGI environment where like everything is taken care of, like, and it just goes and does its own shit. I just don't seem to be able to get there. I know, Aaron, you think we're in a simulation, which
Yeah, I do think I do believe AGI is possible, if not even inevitable. I think for me the question is timing. At what point? We've already got this developing thesis that pure play SaaS isn't enough.
yeah, true. Like we've moved. It's very hard for us to look at pure play SaaS now. We've got, I think, some really cool things that provide a little bit of a moat that even if, let's say that AI just takes over and automatically builds these platforms, you still got to get the data. And I think we've got some interesting ones there.
Yep. Interesting times.
Just sell the portfolio the year before it comes. We use AI to tell us when AGI is coming, and then we put everything on the block. I only really added this one just late, only because it's talking about this dilemma where these big companies like Meta just have to keep spending and spending on AI. Otherwise, they get killed by Microsoft and whatever else. But the main thing, I appreciate my own midlife crisis, but I just mainly want to, I mean, Zuck, look at, he's got the gold chain. He's got the glow. He's got the brofro. Like Zuck's just, look at that. Anyway, all it was saying is when you just have a look at the sheer amount of money that they have to invest, the amount of revenue, obviously, it's not rocket science, has to go up, but it has to go up exponentially. And there's a really great, that 20 VC one that I just took that excerpt from, that guy's from Sequoia. He's really unpacked the data center world. And I learned some things about data centers that I hadn't really thought about, because in reality, compute has to come from somewhere physical. It's actually the ability to build these data centers, get them running, and then now we're putting in chips with new cooling things that we've not done before. There's a good chance that these data centers aren't going to be built right, and then NVIDIA brings out the next chip, so you then got to go and redo the data center and redo the cooling, and people forget that the internet is one big cable on the sea, and the data and the compute is all physical stuff sitting in a big ass shed. Yeah,
there was a conversation last night at the dinner around these data centers being built in freezing cold locations, but sitting on thermals from volcanic activity and subsurface heating. And that drives the energy, but then they don't need as much cooling in the data center. But the problem is these things are so far away, so then they have transmission issues. It's just like, it's a fascinating space, and the scale of these facilities that are being built and the capital being deployed into them, and just an increasing, like ever increasing demand for them.
Yeah, well, that's huge.
But this article, Don, that you found, Nick Bonyhady, like that stat in there that's quoted, Sequoia Capital has spotted a $500 billion hole, like the differential between investment into AI versus the revenues being generated, which they've put at $75 billion a year. Is it just early in the cycle? Is that just all that data highlights? But it's the numbers are interesting.
We provide interesting numbers with no insights. That's the core value proposition of this podcast.
Well, they do say lies, damn lies, and statistics. Like it's their numbers. Causality is the interesting part, and we can hypothesize. But
should we get to some charts?
Let's do it.
So this was, I think, on Monday when the markets melted down, when everything's red. Now the size of the block is effectively the size of the market cap lost. I feel really dumb. I've just been that busy balancing so many different things. A couple of times I had said to myself, with the VIX at like 11 and 12, I should just buy some VIX calls. The VIX spiked the highest since March 2020 from like 12 to 65. So if you bought them unleveraged, not a bad return.
Yeah.
You bought VIX calls, you've probably at that level there, you've probably just gotten 4,000 to 5,000% return.
It was about 3 or 4 weeks ago. I remember being in the car thinking, I've got to look at the VIX. Like now it feels about right. And then I actually saw that. I was like, fuck me.
Anyway, I'll wait till next time. I do remember in 2007 when I was on Morton Island, the market absolutely tanked only for it to come back up again. So
Yeah.
I don't, nothing happens linear. So I can see vol coming back and then shooting off again.
Yeah, I think so too.
And so this is the chart of the Nikkei from 12-month chart. And effectively in a couple of weeks, it's lost more than its gains for the last 12 months, reaffirming markets climb by the stairs and fall by the elevator. But have a look at that, 39,000 to 31,000 in 2 trading sessions. So no wonder. Now, what part of the problem is the year-on-year growth rates of these big tech companies. So this is Meta. Just see how they're a nice swing. Down to 32%, up to 71, down to 38, up to 60, down to 44, and Meta and Apple's growth rate has actually turned. And so if you've got an environment where growth is slowing and finally people are going, maybe the US will get a recession and maybe the Federal Reserve is starting to make the wrong noises. So this is a chart on earnings calls for S&P 500 and stock 600 companies. This is the number of companies that reference what the Federal Reserve is going to do. And it just demonstrates the financialization of this industry. So pre-2000, before you had the printing press go burr out of the Fed never really had any effect, as it should. These unelected officials going and changing money supply, interest rates. But have a look at it now. It's just up and to the right of just companies referencing the Fed in their earnings calls.
What I love is Bloomberg has someone pulling this data.
Yeah.
Like what a data set. Far out.
Like all of these CEOs, please, Federal Reserve, drop interest rates.
We don't know how they were referenced on the calls. Like, fuck the Fed. Like,
Yeah. Now, just a reminder of the yield curve. The yield curve is where you take the 10-year Treasury yield and you minus the 2-year Treasury yield. And when it goes negative, when the yield curve inverts, people have said, well, that is creating the conditions for a recessionary environment because shorter-term rates are higher than the long-term rates. And because this has been a record amount of time since the yield curve went negative, a lot of people started to say it's different this time. The yield curve doesn't predict anything. But like we said in one of the previous articles, the problem is there was about 2 years of COVID cash sitting with consumers in the US. And so the consumer has had this 2-year buffer. And now the yield curve is leaving its negative territory, which has historically been the signal that actually recession is coming. Now, maybe it is different this time, but if you have a look at that going back to the 70s, yeah, I'm not sure I'm ready to bet against it.
no, a reasonably consistent indicator, isn't it?
But with all this talk of the Federal Reserve, like in 2008, the Fed cutting emergency interest rates, like it first started to cut them in January 2008 when things were looking a bit wobbly. See the blue line? Cut. But then have a look at the S&P 500 and the NASDAQ. The Fed cutting didn't actually save the markets. But we did enter recession. And this next chart, what this chart shows is actually from the point that the Fed cuts interest rates, the market going up or market going down actually depends, and it makes sense, on whether we did get a recession. And if the economy enters recession, then you can see the market goes down. If the economy doesn't enter a recession and therefore money gets cheaper and they're able to hit the flywheel, the market goes up. I mean, that's intellectually makes sense, but there's the data on it. And so the bet people that are buying this market are going to have to make is whether the Fed can actually do a soft landing and cut interest rates whilst stopping it going to recession. But there's a whole lot of data sets that say that that's getting increasingly hard.
Yep.
I need to acknowledge Peter Davis had actually sent me a PDF with some AI data that I was going to get out this morning. I've given it was a struggle to even get out of bed. Peter, I appreciate you sending it. It will be on next week's episode. I just couldn't get there. Coming back to the data centers, have a look at this unprecedented demand for larger leases. Since 2015, so about 10 years, there's been 11x increase in new leasing demands for data centers. And that chart is only going up and to the right. And they're also getting a lot bigger. Back in 2019, the largest single lease was 25 megawatts. It's now 340 megawatts. Like these things are just getting bigger and bigger. And therefore those with the capital are going to win. Like you can just see the combination. Here's the data data center capex by the largest 5 hyperscalers, so Meta, Amazon, Microsoft, Google, and Oracle. In 2021, they spent 100 billion, and then now they're spending 200 billion. So again, that just keeps going. And then this I thought was just a little bit funny. This is the last thing before receiving a $500,000 bill for a PowerPoint delivered by 3 22-year-olds telling you to increase revenue and decrease your costs. Deloitte. I must admit, I have a chuckle at big companies that go and hire these consultants that their number one value is really cool PowerPoints, telling you what you already know.
There's so much truth in the post.
What are we looking forward to? I'm going to go get a quick nap before this next. We've got, 5 interviews today?
Yeah, more interviews today. And then I'm heading into the precinct to do a reverse pitch of Tribe to founders as to why they should come see us.
Oh, yeah. Enlighten us.
Well, I'm looking forward to it.
So you literally have nothing at the top of your tongue to roll out. Is that what what are you throwing out, lollipops or what?
No, I'm pitching the value add beyond the capital. Any investor can give you capital. But have you met us nutcases?
Yeah. Only us deliver a podcast every week.
Yeah. Only us will give you a letter saying how you're going to die in the future.
Oh, that's true. Well, yeah, we discussed that last week.
Yep.
Been some interest in that, so that's good.
But no, this weekend I'm ducking off with some of my mates for a bit of a not Bucks party relaxation weekend, which will be good.
Aaron's getting married, Jack.
Yeah, you may not know the date, Jack. It's 24th.
Hey, we're going to make the grand final first. Could be a late.
Yeah.
Late cool up.
Mate, if you don't make the grand final, holy moly.
What are you looking forward to, Jack?
So we got the quarterfinal this week. So yeah, if we win this, we go straight through to the grand final. But we've had a bloody heap of injuries, so we've got a lot of new players in from all grades.
Yeah, so that'll be an interesting mix-up.
Yeah, like we've got 2 blokes that have never played in our team starting. Like, so I feel so bad for the seconds and thirds because they've got forwards playing backs. Like it's all over the shop, but like we still got the team to win. Every grade's still got the team to win, so that we don't have an excuse to fall back on. But it just means we've got to fight harder.
Great. All right.
Well, hang on, Don. What are you looking forward to other than
I'm going back to bed.
furnace thoughts?
I'm supposed to be doing somewhere between 2.5 and 4 hours of training a day, which prior to this little thing, I get up at 3:30. I come into my office. I've got my Wahoo thing, and then I'll do that till 5:30 until the kids are up. And then so that's what I'm supposed to be doing in order to not die. And and I've been really actually enjoying it. Like yesterday before a meeting, I went, I got half an hour. I'll quickly smash out a quick run. It's rewired my brain.
So good. I know you're off social media at the moment, but the weirdest thing has happened to my feed. I'm getting all this stuff on Iron Man related content. And I swear it's just listening to our conversations or something, or you're feeding it just to subtly have a dig at me for doing jack all and nothing. But it's weird that I'm just getting inundated with it now.
Well, we've got 4 weeks.
Hey, you're
which 3 weeks? 3 weeks of training if you have a week of taper.
I've got a wedding in there and all sorts of other things. But you'll be fine, Don.
Yeah, I'll be all right.
Oh.
Yeah. All right. I'll hit the hay and I'll see you on the other side.
All right. See you, boys.
See you guys.